Hello, hello. Hello.
Hi, Jason. Can you hear me?
I can. How are you doing?
I'm fine. How are you?
Doing okay. Sorry, I'm a couple, or I guess now a few. I'm sorry I'm 10 minutes late. I just had a few things going on.
That happens. So, yeah, did you get a chance to go with the questions, Jason?
Yeah, I saw that. I saw them. Yeah, and they're pretty
Okay.
straightforward. So happy to proceed in that direction.
Okay. So, if you're good to go, I'll just start with the podcast. So, basically, I'm going to pretty much stick to the questions. It's going to be more so like we try to keep them around like 15 to 20 minutes, no longer than that, to keep the answers as concise as possible for our audience.
Okay, and then quick question for you, just in terms of the context. So obviously, on the first question, you talked about a little bit of what I'm up to. When is this airing? Or kind of when? Remind me when most people
Yes,
will
so
have access to this.
tentatively it will be around end of April or the first week of May.
Got it. Okay, because the one thing to call out, I guess, is I'm currently um, doing a few things, but will be changing my role, essentially leaving my Google role officially this summer to fully focus on my fund, and so that was one thing I wanted to kind of call out, I guess, and I'm happy to say that in the podcast, but just wanted to flag for you in case there was one you wanted me to emphasize more or less,
It's totally up
which I
to you.
imagine would be more the fun. Okay,
It's
awesome.
totally your call, yeah. So
Awesome.
if you're okay, so if we're good to go, then shall we start?
Yeah, let's do it.
Hi, Jason. Welcome to Better Tech. Let's start off today's episode with your introduction, what you're currently doing, your job, and then we'll move on to our topic for today.
And yes, for those who don't know me, my name is Jason Scott, and currently wear a few hats, but I'd say they're all touch startups and venture capital in some capacity. And so one of those hats is for the last 4 years leading into 2022. I've been leading a lot of Google's startup ecosystem work, which includes high touch accelerators, working with partners like Techstars in the ecosystem, as well as a lot of our digital content at Google. The last 2 years, I have been really passionate about angel investing and creating more underrepresented check writers, and so have spent a lot of time forming angel collectives and ultimately allowing people to have access to angel investing. And then most recently, over the last year, have been launching my own fund called Annam. And so that fund will be focused on investing in entrepreneurs around the world and supporting them both financially as well as operationally. And so that's a little bit of what I'm up to.
Right. So how's that going, the agent investing and like starting your own fund?
Well, I won't say it's easy by any means, but it's going great. I ultimately love the angel investing and supporting founders. I love investing in their businesses, both financially and operationally. And so on the angel investing side, I've been angel investing for some time. So I used to be a scout investor for Lightspeed Venture Partners from 2016 to 2018. And then since then have been angel investing on my own. So I have about 25 to 30 or so angel investments since then. And then on the fund side, for anyone who's, I guess, thinking about raising a fund, as I mentioned earlier, it's no easy task, but it's always great to be able to.
Yeah.
Someone said to me once that if the perfect fund for you exists, you should just go join it. But if not, you should raise your own. And so for me, I was very, very passionate about creating a fund that was really focused on access, right? And really focused on access to venture capital, access to the support of Silicon Valley. And so really want to make sure that the barriers of proximity were not existent in this fund. And so I was really excited to work with my partner to launch it.
Right. And I'm sure our audience cannot wait to hear more about it. So, with that, let's dive into today's topic, which is learning the VC game and preparing for startup growth. First of all, Jason, tell our listeners about who the venture capitalists are and what education is needed to be a VC.
Yeah, so I mean, traditionally, venture capitalists have been folks who, and I would say when I say traditionally, I mean kind of over the last few decades, venture capitalists were mostly people with kind of experience and kind of work experience in more of the financial sectors. And those are people who were professional investors, right? So people who basically took capital, either their own or raised it from other, what we call limited partners, and invested it in early stage, mostly tech startups, but early stage startups. As of late, VC has really started to adapt, and you have a lot more people who are former operators, so people who've worked either starting their own startups or working for startups or even big tech, who ventured into venture capital and kind of bring their operational
Right.
experience to the table, because so much of it is based upon being able to understand, is this a viable business, is this a scalable business, is this something that um, will that customers will want. And then even more recently, over the last 2 years, you've seen just a lot of the rise of what I call the angel investors and the angel investing collectives. These groups of people who maybe share some sort of affinity. Maybe they used to work at the same company. Maybe they are in the same function, and they invest. They pool their money together, invest together in these early stage startups, and bring a lot of operational value, or at the earliest of stages, rolling up their sleeves. And so you see so much more of that, which is awesome, because traditionally a big barrier into starting companies has been having that access to a little bit of capital early on, from what we used to call the family and friends around. And now these angel investors are really helping folks get access to enough capital to kind of get started, to jumpstart their businesses early on.
So how do they create value exactly?
Yeah, I mean, it's funny because there's no single way. I mean, obviously, the most obvious way is in access to capital, right? You need
Yeah.
capital to pay for starting your business, but a lot of both VCs, institutional VCs, so your big kind of brand name VCs, as well as angel groups and even family offices, tend to specialize, right? Either they specialize in a specific vertical, so maybe they know healthcare very well, or fintech very well, or property tech very well, or a specific geography. So maybe they know North America really well, or Southeast Asia really well, or Latin America very well. And so a lot of times they bring that operational expertise, or that functional expertise, or that regional expertise to the founders to really help them know how to, hey, we are looking to build our infrastructure, and let's bring on someone who really knows backend infrastructure. Or hey, we're really struggling with customer acquisition, let's bring on someone who really knows customer acquisition and building sales teams and sales pipelines. Or hey, we are really struggling with our brand, let's bring on someone who knows brand and marketing. So a lot of founders these days are looking for investors that know something that can be additive to their business, not just the capital.
And what's the reason that why, I mean, understandably, they are like, skeptical of where to invest and all, but what are some of the reasons why VCs are tight with their investments? What are the risks and challenges that they have to face?
Yeah, well, something that a lot of people don't really think about is, and I often tell my founders to think about, hey, who are the VC's bosses, right? Who are the people that they have to appease, right, or please? And so at the end of the day, VCs, are institutional VCs in particular, are usually burdened with making sure that they're bringing in enough of a return, so a financial return for the people giving them money, right? Because they're not investing their own money. Most of the time, they're investing money from other either institutions or high net worth individuals. And so oftentimes they are making sure they're mitigating the risk of failure, because 80+% of early stage startups are going to fail, right? And so they need to know that within that small percentage that won't fail, that will have an exit, that they will make up for the failures of the others, right? And also give them at least a 3 to 5x return for their investors. And so that is why you see some hesitation, particularly at the earliest of stages, because a lot of it is risky, right? It's very risky. It's not necessarily gambling per se, but it definitely um, is a lot of going with your gut, and kind of a lot of hypotheticals, a lot of experimentation. And so you'll see that VCs tend to, and this is where some of the biases come in venture capital, but they tend to invest in things they know, or things that they feel are lower risk, and so things that are familiar.
Okay. So when it comes, speaking of from like a founder's perspective, so if you're choosing which, I don't know which fund to get on board with and everything like that. So how do you decide what are the funding options that you would go with? Should you go with venture capitalists, or should you go with equity investors? What's the difference exactly?
Yeah, I mean, I guess the biggest question is, do you go with dilutive or non-dilutive capital? And so what I mean by that is, Diluted capital is a traditional venture where you're giving away a piece of your business, right? Some ownership stake in your business. Or non-diluted capital can include everything from grants to loans. And so, of course, if you're giving away some stake in your business, then that means your business needs to get eventually get to a certain size that that stake you'll have enough to give away, and also some for yourself, right? And some for your employees. And so I think the first question is, where is this business going to be in 5 to 10 years? Is this going to be, am I aiming for it to be $1 billion company, also known as a unicorn, or am I aiming for it to be um, smaller than a company, and not necessarily a small company, but it doesn't have to be a mom and pop shop. But at the end of the day, for it to take venture capital, it has to reach a certain scale for that to even be a viable or a logical option, right? And so that's the first question entrepreneurs should ask: like, what is my ideal vision for this business? Because at the end of the day, there's no right answer, right? You are the founder, and so you have to decide what is my vision for this business. But after that, it's a mixture, right? And I would say, for sure, if you can get non-dilutive capital, if you can look for, I love when the scrappy founders, are able to find grant programs that they can tap into, or maybe those are federal grants, or maybe those are grants from certain institutions. A lot of times you can find ways to get some capital to start your business that doesn't require you to give away equity stake, right? And so oftentimes people go straight to venture, and I would say go to venture when the other ones are not viable, right? Given kind of the scale of the business or kind of the outlook of the business.
Okay. So, with so many investment opportunities and startup pitches, if you were to break it down to a certain like 4 or 5 points of criteria, what's that criteria that VCs often look for to evaluate before they invest in a business?
I mean, the first, and maybe this is obvious, but the first criteria is, will someone pay for this, right? Like, is this a product that someone's going to pay for? Because I think so many people, and you see this now with a lot of the kind of infamous startups that are shutting down before they even reach a certain amount of revenue, because people were putting in so much money before they even had someone willing to pay for the product or the service, right? And so that's the first thing, right? Have they proven that someone is willing to pay for this? Like, what is their how have they proven that hypothesis? Do they actually have users? Is there like a direct substitute that they're aiming for? And then kind of how viable is that, right? The substitution. After that, for me, the very first criteria at the end of the day, especially at the earliest of stages, is this the best person to be solving this problem? And what I mean by that is, do they have the right expertise, experience, as well as the right passion for solving this problem, that they will have the wherewithal to withstand kind of the many externalities, global pandemics, personal situations, pivots, et cetera, that they have to make over the next 7 years before they're actually going to reach and a potential exit, right? And so though that's at the earliest of stages. Of course, as you get more and more mature, you look at things like customer acquisition costs, like how much does it cost for them to acquire their customers. You look at kind of their operating model, like their unit economics, things like that. But in the earliest of stages, a lot of it again is this something that people are willing to pay for, and is this team well equipped to be able to solve this challenge?
So, again, when the startup founders are approaching VCs and investors, how should they evaluate themselves?
Also think about who's the investor, right? So like different types of investors are going to have different kind of end games, right? Angel investors, many times at the end of the day, they're just looking to, and this is why I love angel investing and angel early stage angels generally, is that a lot of times they're not necessarily looking for the same kind of 3 to 5x returns as the venture capitalists, right? A lot of times they are, one, just excited to invest in you as a founder, and you should be finding those people. But they're also just so passionate about the problem that you're solving. And so I'd say for that audience, you emphasize you, kind of your experience, like why are you the best person to be solving this problem? What are your gaps, and how are you filling those gaps with advisors or other folks on your team? And then three, how can this person as an angel catalyze my ability to solve this problem even faster, right? When it comes to institutional investing, again, it's all about returns. And so you have to make sure that it's very clear that they know in your story, in your opportunity sizing, in your path to exit, that they realize that in the next 5 to 7 years, they're going to be able to get at least 3 to 5x their money back, if not 10x, right? Because that, like I mentioned earlier, they're trying to get 3 to 5x on average, and they know that a lot of these companies are going to fail. So I often say, like, how is this a 10x opportunity, right? And so as long as you're able to tell that story, combined with why you are the person that's most likely to be able to achieve that with you and your team, then I
Mhm.
think you'll be in good shape.
So, in a quest to accelerate the growth of their portfolio companies, we know that VCs today are bringing entire teams of startup specialists in house. How is this benefiting the startup scenario?
Well, that's what I mentioned earlier, right? Like, so many, it used to be that these institutional VCs were very much people who had been in the kind of financial services for most of their careers. I think a lot of people are realizing that, one, in order to compete for deals and the best deals, but then two, in order to mitigate the risk of failure, you actually need folks who have that operating experience in house. And so it's great for startups, right? Because at the end of the day, a lot of these VCs have within their teams people who have that experience when it comes to sales, or have that experience when it comes to growth, or have that experience when it comes to technical infrastructure, artificial intelligence, machine learning, et cetera. And so those are things that a lot of these folks are are bringing in house to be able to support their company.
And Jason, what are some must know tips for building a high growth startup?
Yeah, I mean, at the end of the day, like I said, it's all about the people. So making sure that you are surrounding yourself with the right people to be able to mitigate the risk of failure. Because at the end of the day, I often tell my founders that you're just running experiments, right? From day one, you're running experiments and you're continuing to refine those experiments. I was a biological sciences major, I guess, in university. And so that's why I think of things in this lens, but you're just trying to solve a really complex problem one step at a time. And so think about, what hypothesis do you have right now? What's the first hypothesis that you can test to get closer to your North Star as a company, and continuing to iterate until you kind of get there, right? And so that, I think, people tend to be overwhelmed, either overwhelmed by kind of the ultimate North Star that they're aiming for, or they tend to not be able to break the problem down into digestible steps for themselves and their teams. And so I think of it as one hypothesis at a time. Today, we think that these are the three biggest things in the way of us getting closer to our mission statement and reaching our mission statement. Okay, let's start tackling those things, right? And like running these experiments. And of course, some of those experiments are going to fail, but you need to be able to learn quickly from those experiments, and then learn where you're going to double down, where you're going to abort mission, or where you just need more data, right? And so think of it as an experiment that you're continuing to understand what inputs lead to what outputs to eventually reach your North Star.
Right. So, Jason, this brings us to an end of our episode. Lastly, what's one tip that you have for a future investor or VC, and what's one tip that you have for future startup founders?
I think I think my tip is going to be the same in both cases, but no, actually, it won't. For VCs, I would say you got to start now, right? For any VC, you kind of start doing VC before you even have the capital to do VC, right? A lot of folks that I know that have gotten into VC have either started by, hey, like, maybe I don't have the ability to actually invest my own capital into this company, but I'm going to pretend like I do, and I'm going to still build a pipeline. I'm going to still start sourcing. I'm going to still start doing analysis, and then maybe find someone who does, like, maybe find some angels that you can share deals with, or some institutional VCs you can share those deals with, and start building your own pseudo portfolio, and then eventually maybe even with your own capital, right? But ultimately, in order to get in VC and be successful in VC, it takes practice, right? And so you need to make sure you're practicing and building that muscle, right? Of being able to build a pipeline, analyze a pipeline, and understand deal terms and invest. On the startup side, honestly, I think there's so many tips, but I think the biggest one is generally, I would say, being bold and asking for help, and being bold and making sure that, and leveraging your network, and even those outside of your network, and being a little bit shameless, right? I think ultimately it takes a village, and no successful founder that we know of has done it, has succeeded on their own. And
Mhm.
most of the ones that you see that are most successful are able to kind of tap into their networks in a very, very efficient and as I say, shameless way, right? And ask for help. You never get support that you don't ask for. And so I often tell my founders, worst case scenario, if someone says they can't help you, right? But if you never ask, even if it's a stranger, then you'll never know what they would have said.
Yeah, those are some great tips. So with that, our episode comes to an end. Thank you so much, Jason, for joining us on Better Tech.
Of course. Thank you for having me.
Right. Have a good day. Bye.
Bye.